Have you ever wondered how multinational corporations navigate the delicate balance between ethical transfer pricing practices, ensuring fair intercompany transactions, and optimizing tax efficiency, especially in an era of increasing scrutiny from tax authorities and the public? Do you want to find out? Wait no more! Hello everyone, welcome to Counting Coins, where we explore your financial needs. Today we are delving into the complex world of transfer pricing and how it works. Let's put on our thinking hats together as we get to know transfer pricing more. Let's start! Transfer pricing is an accounting methodology that signifies the cost at which one segment of a company bills another segment for the goods and services it supplies. This practice facilitates the determination of prices for the exchange of goods and services among subsidiaries, affiliates, or entities under common control within a larger enterprise. While transfer pricing can result in tax advantages for corporations, their assertions may face challenges from tax authorities. The mechanism of transfer pricing involves the internal pricing of transactions within businesses, spanning both domestic and cross-border activities, and applies to subsidiaries operating under common control or ownership. This accounting and taxation practice establishes the cost at which one division, subsidiary, or holding company charges another for provided services. Transfer prices are typically aligned with prevailing market rates for the respective goods or services, extending even to intellectual property such as research, patents, and royalties. Legally, multinational corporations are permitted to employ transfer pricing to distribute earnings among their subsidiary and affiliate entities within the parent organization. However, companies may exploit this practice to manipulate their taxable income, thereby reducing their overall tax obligations. This utilization of transfer pricing serves as a means for companies to reallocate tax liabilities to jurisdictions with lower tax costs. To gain a deeper insight into how transfer pricing influences a company's tax liability, let's examine a hypothetical scenario involving an automotive manufacturer with two divisions. Division A, specializing in software manufacturing, and Division B, focused on car production. Division A not only sells its software to external car makers but also to its parent company, with Division B making payments to Division A based on the standard market price charged to other car manufacturers. Now, suppose Division A opts to charge Division B a lower price than the prevailing market rate. Consequently, Division A experiences a reduction in sales or revenues due to the discounted pricing. Conversely, Division B witnesses a decrease in its costs of goods sold, leading to an increase in its profits. In essence, the decline in Division A's revenues corresponds to the cost savings realized by Division B, resulting in no overall financial impact on the corporation. However, consider a scenario where Division A operates in a country with higher tax rates than Division B. In this case, the company as a whole can achieve tax savings by diminishing the profitability of Division A and enhancing that of Division B. By having Division A implement lower pricing, passing on the resultant savings to Division B and elevating its profits through reduced COGS, Division B becomes subject to a lower tax rate. Essentially, Division A's choice to deviate from market pricing for transactions with Division B enables the entire company to mitigate its tax obligations. The IRS emphasizes the need for consistency in transfer pricing between intercompany transactions, asserting that the pricing should mirror what would have occurred if the company had engaged in the same transaction with an external party. According to the IRS website, transfer pricing is defined as ensuring that prices in intercompany transactions align with what uncontrolled taxpayers would achieve under similar circumstances. This stringent approach by the IRS means that the financial reporting of transfer pricing is subject to rigorous guidelines and close scrutiny by tax authorities. Auditors and regulators often demand comprehensive documentation. If the valuation of transfers is inaccurately or inappropriately conducted, it may necessitate restating financial statements, and the imposition of fees or penalties could ensue. Despite these guidelines, there exists considerable debate and ambiguity regarding how transfer pricing between divisions should be accounted for and which division should bear the primary tax burden. Examples of transfer pricing disputes. So, Coca-Cola's dealing with this transfer pricing issue. They're having a bit of a back and forth with the IRS over a $3.3 billion royalty deal linked to moving intellectual property around to their subsidiaries in Africa, Europe, and South America from 2007 to 2009. The case is still in court, and there's no resolution yet. Medtronic. Now, Medtronic, the medical device company from Ireland, is also in a bit of a tiff with the IRS. They're not seeing eye to eye on shifting intellectual property to some low-tax places globally. The whole thing is about the value of intangible assets, going back and forth between Medtronic and their Puerto Rican manufacturing buddy for the tax years 2005 and 2006. First, the court said Medtronic was too good to go, but when the IRS wasn't happy and appealed. In mid-2022, the court changed its mind, saying Medtronic didn't prove its case and the IRS was a bit off in how they wanted to price things. Tough break. Comparable uncontrolled price method. This method is frequently employed in transfer pricing, comparing the price charged in a controlled transaction to the price charged in an uncontrolled transaction for similar goods or services. Disadvantages of transfer pricing. Revenue risk. One key disadvantage is that the seller is exposed to the risk of selling goods or services for less, resulting in lower revenue. Tax loophole for multinational corporations. Transfer pricing practices can provide multinational corporations with a tax loophole, allowing them to strategically reduce their overall tax burdens. Purpose of transfer pricing. Earnings distribution. Transfer pricing serves as a legal mechanism for large businesses to distribute earnings within their organization, ensuring a balanced allocation of funds among parent companies, subsidiaries, and affiliates. Tax burden reduction. While the primary purpose is earnings distribution, many multinational corporations exploit transfer pricing to lower their tax burdens, often leading to legal battles with tax authorities such as the IRS. In summary, transfer pricing, although a legitimate business practice for earnings distribution, is frequently utilized by multinational corporations as a tactic to minimize tax obligations, resulting in disputes and legal challenges, such as those faced by Coca-Cola and Medtronic. In conclusion, transfer pricing serves as a complex yet legal tool for large corporations to manage their finances and distribute earnings across different facets of their operations. While it is designed to ensure financial equilibrium within an organization, the practice often becomes a battleground between multinational corporations and tax authorities, exemplified by ongoing disputes like those involving Coca-Cola and Medtronic. If you found this exploration of transfer pricing and its real-world examples insightful, feel free to like this comment and subscribe for more updates on complex financial concepts and their implications. Your engagement is crucial, and we look forward to bringing you more valuable insights in the future. Thank you for watching. See you in the next one.